G'day, welcome to this week's Facebook Livestream Q&A. It's great to see you, thanks for joining me. And bloody hell, it's cold in Melbourne at the moment. I'm freezing. Well, not in here, but I feel like I'm in Norway or something at the moment. Dear oh dear. But anyway, I'm sure if I was in Norway, I'd certainly be colder than I am here, so probably we're doing okay. Now remember, the live stream and my answers are general advice only and may not be appropriate for you, so please bear that in mind. And if you have any questions as we're going along, please feel free to pop them into Facebook and we'll definitely get to them. So we've got a few questions today, as usual, which is great. Half an hour ago there were hardly any, or none actually, so they all came in with a rush, which is great. I thought we weren't going to have a session this week, but now we are, and that's fine. So let's get stuck straight into them. Roger says, further to my question about the measurement of the CPI last week, where Roger asked about whether house prices are included or should be included, should CEO pay rises be included in the statistic? Well, Roger, of course not, but I see where you're coming from. It's a nice thought, but no. The CPI stands for Consumer Price Index. It's meant to measure the prices of things we buy. So yes, I understand that we kind of buy CEOs and we kind of pay for them indirectly, but no, they are not yet consumer products CEOs, unfortunately. Maybe they should be, but they're not. Lacey says, this is a bit of a long question, but it's worth persevering with. It's quite an interesting question. Lacey, thank you. What tech-enabled developments do you see affecting the future of money, including in the context of investing? Background, I'm hosting a Future of Money panel in September in Perth for Women in Technology WA. It's a not-for-profit, I'm on the committee. I want to get panellists talking about the tech changes that affect how we'll use money in the future, including how we invest. Blockchain has a big impact, obviously, but plenty of other tech-enabled developments like tap and go, peer-to-peer lending and online shopping have changed how we use and see money in the last couple of decades. What else is there coming? How will it affect our behaviour, and how much more or less savvy do we need to be about investing in the light of these changes? Well, the things you've mentioned, tap and go, peer-to-peer lending, online shopping, obviously are with us already, and I think they are not going to go away. So they are, I think, permanent developments. My view is that the biggest changes to the world, and in particular to the world of money, are blockchain and artificial intelligence. Those two things, both separately and together, are colossal developments. But the trouble is, I don't actually understand or know exactly how they're going to change things. To be honest, I mean, I do think that blockchain is going to become the sort of standard place for collecting data. As to whether cryptocurrencies will become money in future, I don't know. I don't think anybody does. I think there's a fair chance that some of them will. There are currently 1,600 cryptocurrencies. They won't all be around, but a few of them will be around and they will become part of our spending, I think. So that's one thing. Artificial intelligence is affecting every part of life. I do think it will begin to have an impact on how we invest, but it's already doing that, in fact, through what's called robo-advice, which is where there's a sort of a artificial intelligence machine that gives you your asset allocation or portfolio suggestions. People are running them in order to replace financial advisors. I mean, I do think there's always going to be a place for human advisors, but I think that it's shifting over time, and I do think that artificial intelligence will get better, and I think that it will continue to replace human advisors. So I think that AI will have a big impact in time on how we invest, how we go about getting advice. Beyond that, I mean, obviously there's going to be things that are happening that we need to take into account as we think about investing, such as driverless cars, all sorts of changes in the world, for example, automated robotic bricklaying and so on. I think that things are changing rapidly now, and I do think that as investors we need to be on top of these things and think about what's coming and to keep an eye on it. So that's about as much as I can say there. If I have any further thoughts, I'll stick them into Facebook, Lacey. Otherwise, actually, if you feel like sending an email to the main email address, hello@theconstantinvestor.com, Phoebe will pass that on to me, and I'd be happy to give you a call perhaps, and we can just have a chat about it. So try that, Lacey. Michael says, thanks for the interview on Monday with Sea Farms Group. I'm already a shareholder. What are your thoughts on the company? Now, Michael, this is a bit reminiscent to me. I can't remember. I feel like I've answered this question already. But anyway, my thoughts on Sea Farms is that it's potentially an enormously profitable business. I think it's a good idea to invest in it for you. I don't know enough about the business. I've done the interview with the guy, but I haven't researched them, so I can't really express a clear position on whether it's a good investment. I think it's very difficult to anyway, because you can't actually measure the cash flow and the profitability of the enterprise. It's basically too early. Basically what they are is they're a big. It's like investing early in a spec apartment, development, or even a drug company that has to go through all the trials. I mean, it's going to be years before they start producing massive amounts of prawns. I mean, they're obviously producing prawns already from their farm in Queensland, but the reason you're buying Sea Farms is for the big prawn farm projects in Northern Territory that they're building, and that's going to be enormous, really. And I think it's a speculative investment, well worth perhaps putting a few pennies in, but you wouldn't want to. You wouldn't want to put all your eggs in that particular basket. I would thought. I mean, there's a lot of things a lot of potential trip ups along the way that could be a problem here in the years ahead. Whenever there's a long time frame for a project like this, you're taking a risk because things could happen that you don't know about in the time. Desmond says, following your Crypto Watch interview with Ken Anderson, I listened a bit to Lehman Baird. Seems to me that without saying so in so many words, he effectively demolishes Bitcoin as an investment. What do you think? Well, I certainly haven't invested in Bitcoin. I note that actually in the last week or two it's gone up from 6,000 something to 7,000 something, so it's having a bit of a rise at the moment. I really don't know about Bitcoin either way as an investment. I mean, the thing I would observe is that in the world of cryptocurrencies that Lehman Baird mixes in, I mean, just to remind you, everybody else, he's the founder of Hedera Hashgraph, which is a business that's designed to, oh God, what is it again? You have to look it up. It was an interview I did with the bloke who works for Lehman Baird. Lehman Baird started this thing called Hedera Hashgraph. But anyway, what I was saying is that all the people in this world are passionate about what they're doing. They seem to all hate each other, or at least they are rivals, and they all have strong, passionate views about everything else. People running Ethereum or Litecoin reckon that Bitcoin's hopeless, and people running Bitcoin reckon that the rest of them's hopeless. So I wouldn't say you discount the views of all these people entirely, but you just need to be aware that where they're coming from. So the fact that Lehman Baird has a strong view that Bitcoin is hopeless as an investment, well, maybe, but I don't think that necessarily means that Bitcoin's finished. I mean, I do think that not all of the cryptocurrencies are going to last. I think that's pretty clear. But some of them will, and if I had to bet on, and I don't have to, so I won't, but if I had to bet on which ones would last, I reckon Bitcoin probably will, because it's got the brand. I mean, they do need to fix it up. There's problems with Bitcoin, and I'm sure Lehman Baird is making those problems apparent, but it's slow, expensive, and so on. They have to fix it up. If they can fix it up, then Bitcoin's got the brand, and probably will last. Madan says, "G'day, Madan." He says, "Hi, Alan. I'm planning to invest $10,000 for each of my 2 grandsons, aged less than 5 years, so that I can give them a nice gift on their 21st birthdays. Considering that the money will be invested for at least 15 years, what could be the best investment strategy out of the following options? And it might be a good exercise for you also if you're thinking of investing some money for your newly born grandson, Alfred." Yes, that's a good idea, and I am thinking about that, Madan. And your 3 options that you've asked about are: number 1, buy shares in 4 or 5 good companies. Number 2, buy shares in a listed investment company. Number 3, buy shares in ETF. I'd go for number 2 there. But actually, not just one listed investment company. I think you should spread it among 4 or 5 listed investment companies. I don't think it's a good idea to put them into companies, because you need to keep an eye on companies if you're going to invest in them, and you don't want to, I imagine, spend the next 15 years watching over the portfolio and worrying about it. I think you should be outsourcing the investing to somebody else, in particular good investment managers. I think that the reason for going for listed investment companies is that the minimum investment is kind of nothing at all, so it's quite small. You don't have to invest the whole $10,000 into one fund, as you might have to do with a retail unlisted fund. I definitely don't think you should put the money into an ETF. The returns aren't good enough, and I'm personally biased against ETFs, so you're asking the wrong person. But I think listed investment companies are probably the way to go. I'll publish a list on Saturday of the top 10 performing listed investment companies over the past 10 years. And you can have a look at those. But one group of them, there are 2 funds in the group that I'd recommend, that I really like, Future Generations. Now, they've got 2 funds, one global and one domestic. The global one is FGG, the domestic one is FGX. The reason I like these funds is because they were set up by Jeff Wilson of Wilson Asset Management as a charity thing. So what he did was he persuaded a whole lot of fund managers to give their expertise, their fund management, for nothing. And so Future Generations, FGG and FGX, both charge a fee of 1%, but all of that entire 1% goes to charity, and you get to choose which charity it goes to. Now, importantly, and all that's fine, but it also is a good performing fund. They've got it. Jeff and the people running FGG and FGX have given it to some good fund managers. So they're actually, the performance is good. You can go onto their website, check out the performance; it's terrific, and it goes to charity. Now, the problem with them is, and it's a big problem, is that both of them sell at a big premium to net assets, NTA. Last time I looked, one of them was a 25% premium to NTA, and another was 30% premium to NTA. So that's a pretty hefty premium. But against that, they tend to hold their premium. That's not. Obviously, if they went from a premium of 30% to a discount, then that's bad. You're going to lose performance for sure out of that. But it's okay. Buying a listed investment company at a premium to NTA is okay as long as they hold the premium, and these 2 have tended to hold their premiums. So, but again, I wouldn't put the whole thing into just 1 or 2 listed investment companies, I would say for each of them, perhaps 2,000 into 5 different listed investment companies, and you might pick another 1 or 2 that have that are currently at a discount to NTA. For example, I mean, Blue Sky Alternative Access Fund (BAF) is at a 30% discount to NTA because of all the rubbish, or not rubbish, all the negativity around Blue Sky, which is completely justified. Blue Sky, the company, has collapsed. The share price has collapsed. It's up a bit today, but I mean it's down tremendously. But I'm a shareholder of BAF, the listed investment company, and I haven't sold out. I actually think that it's probably going to recover. So anyway, so I'm not recommending BAF. I'm just saying that it's an example of a LIC that's selling at a discount. The other LICs that I'm in are Thorney Opportunities Fund, which is it at a discount? I can't remember. Anyway, it's got a decent performance. It's run by Alex Waislett. There's the Elliston Global Fund, which is run by Ashok Jacob, and also Bailador Technology Investments, which hasn't been great. It's they invest in second round venture capital, and they haven't had a great run so far. But their code is BTI. Now I'm not saying you should follow me, but I do think that a group of LICs probably is the way to go, and that's what I'll be doing for Alfie. I reckon, possibly just I might just put a few $1,000 into FGG and FGX for him. I think can't do better. I reckon it'll be around for a while, and I think the other thing about that, which I like, which could be good for your grandchildren, Madan, is choosing a charity for them. So not only do they, as they grow up and go into their teens, they can know that they are supporting a charity. So you can give them a culture or thinking about that they're contributing to helping others at the same time as investing. And I think that's probably a good lesson to pass on to them. Gerard says, Host Plus has again been the top performing super fund last financial year with 12.5% return after fees and taxes, and that's right. That's just come out in the last day or two, and it's down a bit from last year. They earned 13.7% last year, Host Plus, but 12.5% latest year. Again, top performing. Some of that's due to unlisted assets. That's true. They've got almost half of their fund in unlisted assets, and that is a big part of their performance, that's for sure. However, Sam Cecilia, the CIO, reckons unless you can switch off technology, inflation and interest rates, inflation and interest rates will remain low for a long time, and therefore equities is the best place to be. And therefore he believes the markets have a long way to go. Host Plus is also moving further to outsource their active investment management, whilst Australian Super is doing the opposite and are bringing their investment management in-house. What are your views on these issues and how they may play out? Well, the question of whether the equity markets have a long way to go is a big one. Look, I think there could be some rough periods ahead. It's kind of I don't think we're entering a bear market. I think that there could be a correction sometime this year, particularly with interest rates rising, trade wars happening potentially, and high debt levels in Australia, particularly with the property market coming off. So look, there are some risks around the markets, which I'm sure Sam Cecilia would acknowledge. In particular, we've got house prices falling in Australia with very high debt levels, and interest rates here are staying the same. But still, there is a risk around house prices and debt in Australia. There's a risk around trade wars globally, and also with the Federal Reserve putting up interest rates. So that said, I do think that we've got global growth of 4%. Companies are doing great at the moment. You know, we have the profit season coming up over the next couple of months, and I think that, you know, what we're already starting to see tremendous profit growth, particularly by American companies. I mean, companies generally everywhere, including Australia, are doing great. So I think Sam's right fundamentally that inflation and interest rates are likely to stay low for a long time, and I think that, you know, the markets do have a long way to go, given as long as you take into account and think about the risks and the potential for short-term reversals within the long-term bull market. As for insourcing and outsourcing, well, Hostplus is number one. Australian Super, I think, is number 3 or 4. I think you can go either way. I don't really have a strong view about that. I can see why Australian Super is bringing it in-house, so they can have more control of it. But on the other hand, if you outsource it, you're giving your money to entrepreneurs, people, basically investment entrepreneurs who are running their own business as fund managers, and they are highly motivated. You know, so I think that's right. And the other thing is that, particularly with unlisted assets, you basically have to outsource it. You know, it's very difficult to buy too many unlisted assets without outsourcing. So. David Moore just comments on future generations. FGX, he says, is a cent or two below NTA as of June 30, 2018, I believe. I did check, David, and I'll have to look it up again. Well, I'll look it up while I'm talking to you. I'm looking at my iris screen on this question. FGX, according to my iris screen, which may be wrong, I guess, the price of FGX currently is $1.29.5, and according to this, the NTA is $1, which means that it's 29.5% premium to NTA. But maybe they've adjusted NTA, which hasn't been picked up by Iris. So I'll have another look at that, but I don't have time now. But thanks for that, David. I will put that into the overview if there's any change that needs to be made, and on Facebook. John says, I'm a bit gloomy this morning. Yeah, I know the feeling. It's cold in Melbourne, and I've been mulling over some big picture issues. It's always a mistake, John. National debt seems to be the elephant in the room. While all the day stuff at ground level seems sweet enough and we concern ourselves with investments which are more attractive or less so, can you see the large indebted countries like the US and Japan at some stage doing an Argentina and defaulting on their debt, bringing the global economic house down, so to speak? No, I can't, John. I think there are plenty of things to worry about, but that's not one of them. I don't think the US is going to default on its debt, and I don't think Japan is going to. That would be a big thing to do, that's for sure. So I just don't think that's going to happen. I think that the debt issue, which I just mentioned before, that we need to worry about when you're mulling things over in the morning, feeling gloomy, is Australia's household debt, not national debt, household debt, and what might happen in the event of serious declines in house prices and an increase perhaps at some point in unemployment. So that's the thing that makes me gloomy in the mornings, is thinking about. But really, so far so good. Interest rates are low, 1.5%, the RBA cash rate, and it's going nowhere. So I just think it's unlikely that that's going to be too much of an issue, to be honest, on balance. But I don't think you need to worry about US and Japan doing an Argentina. Matthew says, gee, you stirred up a hornet's nest on Twitter this week. Well, I did, and I must confess, I rather enjoy poking sticks into the hornet's nests of Trump supporters. I probably should stop it, but I can't help it. I mean, I do enjoy it. But look, I mean, Fennicum, the stuff out of Helsinki was amazing, wasn't it? I mean, was Trump saying that he believed Putin that that they didn't interfere with the American election, even though the American security agencies had completely proved that it had happened and had indicted 25 Russians, 13 civilians, and then 12 officers of the Russian security services were indicted. And I'll put in the overview on Saturday some summary of the latest indictment from Mueller of the 12 Russian security officers. And it's amazing. I mean, Fennicum, it is so clearly established. So then Trump attempted to backtrack by saying he meant to say wouldn't instead of would, or would instead of wouldn't. But it's not as if that statement was out of context with everything else he was saying at that press conference. So, yes, I did have a bit of a crack on Twitter about it, and I had a bit of fun, and people got stuck right into me and said that I should retire and I'm hopeless and I'm just another lefty biased person from the ABC, all that stuff, which is all quite amusing, really. Anyway, so Matthew also says, what's up with APT? It's up 16% this morning. Well, indeed, and in fact, it's 18% now, Matthew, and still going strong. And the US expansion is working. They put out a business update, which was quite long, worth a look if you're interested. I can't really summarise it now, but I have put in a call. Matthew says, any chance of speaking again with the CEO? And indeed there is. And I've put in a request to interview them. Hopefully I'll get them next week. This is Nick Molnar, the CEO, and what a fantastic success Afterpay Touch is, and could be another global champion for Australia, I reckon, in time. Dan says, bottled kombucha containing low sugar, a probiotic and not bad taste, seems to be becoming a popular alternative to soft drink. Are there any good listed companies set to profit from this trend, and do you think it could become like the next A2 milk? I keep seeing, look, I confess, Dan, that I haven't had any kombucha. I've seen it around, and I gather it is becoming popular, and maybe it is another A2 milk. I think it's an interesting question. I'll do some work on it. I don't know whether any listed companies are involved in kombucha. Do you? Let me know if there are. Let me know if there are, and I'll check it out. Michael says, how do you invest in blockchain per se, or do you just pick a company that's using it? There are a few listed companies popping up that specialise in it, like advising on blockchain. One of them is called Digital X, run by Lee Travers. Now, I have interviewed Lee Travers a while ago. I haven't spoken to him for a while, but I mean, they're an interesting little company. They advise businesses on cryptocurrencies and using blockchain. There are, I don't know of any others off the top of my head. It is very difficult. It's difficult to invest in blockchain itself. I mean, blockchain's like the internet. It's simply a protocol that is a way of storing data. So, you're looking at companies that are using it or advising on it, sort of riding the blockchain wave. So I will see if I can find out some possibilities along those lines. But as I say, the one I can think of off the top of my head is Digital X. Daniel says, what would be your number one stock pick on the ASX today? Blimey. I don't think I've got a number one, Daniel. I mean, there's so many. There's 2,000 companies on the ASX, and some of them are great. I mean, a lot of them. I love talking to CEOs. I suppose the company that I like best, and this is the number one company, and this is not some sort of blinding insight, Daniel, but my favourite company on the ASX is CSL by far. It's a fantastic company, but it's up to $200 now, and I think its PE ratio is probably 40 times. I mean, it's not cheap, that's for sure. So you wouldn't, I mean, you know, it's all very well to say this is a terrific company, which it is, wonderful company, CSL. But I'm not saying you should buy it because it's so expensive. But on the other hand, it's been expensive for years and it's still gone up enormously. So that's the trouble with the last few years of investing, is that you know, it's been possible to buy great companies that are expensive at the time and still make a lot of money, and that's quite an unusual situation we've seen. For example, Qantas, another business. I love Qantas. What a fantastic company it is. So well run, and it's actually, unlike CSL, Qantas is actually reasonably cheap. I think its PE is 10 or something like that. Let me have a look. I mean, Afterpay, we were talking about Afterpay. What a fantastic business that is. It's great. Yeah, so Qantas's PE, according to my iris screen, is 12.9. So that's not expensive. The average PE in the market is 15.5. So it's below the average PE. Wonderful business, going to be around a long time, and is, you know, really set to win from the Chinese tourist boom, not just domestically, but also bringing people from China here. So yeah, look, those are two businesses I'd suggest. But look, there's so many great companies on the ASX. I feel like you could just talk for hours on end about all the fantastic businesses that are listed on the ASX. And I think that's it. David Moore has just sent another. I think David has sent me an email now about FGX, to the effect that the NTA of FGX is $1.28. Well, thank you for that. The June NTA for so Iris really is behind. It's 19th of July. They really should be catching up. Pre-tax net tangible assets of FGX, $1.28. So there you are. It's hardly selling at a premium at all. It's $1.29.5, and the NTA is $1.28. So I doubly recommend Future Generations, Nadan. I think it's great, and it's actually not even at a premium now. So there you are. Well, thanks everyone for joining me. It's been great talking to you as always. Today's interview is an interesting one. It's not something you can invest in, but I thought it'd be worth listening to. You might be able to invest in him soon. PT Blink. I think they're going to do an IPO at some point. PT Blink. Oh, they are. Oh no, what it is? Sorry, take it back. PT Blink. They're doing an equity crowdfunding through on-market book builds. And the CEO is Murray Allen. He's a New Zealander, the PT Blink. And what they do is that they are prefabricated building technology. Now, they don't actually do the buildings. They don't build the buildings. They have the technology and they license it to builders. I think it looks a ripper. It's not stock exchange listed. It's an equity crowdfund situation. So check it out. Oh, it's a really interesting interview. I found it interesting anyway, and you can invest in it through equity crowdfunding. And the other thing today, of course, is the Money Cafe. And today it's John Jury, because Kirby is in Limerick visiting his family, which he wasn't that thrilled about. I mean, he loves his family, but he doesn't love Limerick, which is why he came to Australia. But anyway, so we've got John Jury from the Australian in the Money Cafe today. So that'll be good. I'm sure it won't be as lively and funny as JK is, but anyway, so Kirby's away for 3 weeks, and we've got 3 other people from the Australian to chat to in the Money Cafe. So thanks for your company. I'll see you next week.